Hello, and welcome to our YouTube channel, where we explore the intricacies of the global economy and financial markets. Today, we're going to delve into the topic of de-dollarization, a trend that is shaping the future of international trade and finance. First, let's define what we mean by de-dollarization. Essentially, this refers to the process of reducing or eliminating the role of the US dollar in international trade and financial transactions. This trend has been gaining momentum in recent years, driven by a number of factors that are worth exploring in more detail. One of the key drivers of de-dollarization is geopolitical tensions. As the world becomes increasingly multipolar, there is growing concern among countries that they are too reliant on the US dollar, and that this could leave them vulnerable to economic sanctions or other forms of pressure from the United States. In particular, countries that are in the crosshairs of US foreign policy, such as Iran or Venezuela, have been actively exploring ways to reduce their dependence on the dollar. Another factor driving de-dollarization is the desire to reduce currency risk. Historically, many countries have held the majority of their foreign exchange reserves in US dollars. However, this can leave them exposed to fluctuations in the value of the dollar, which can impact their trade balances, inflation rates, and overall economic stability. By diversifying their foreign exchange reserves and holding a broader range of currencies, countries can reduce this risk and improve their economic resilience. The rise of digital currencies is also contributing to the trend of de-dollarization. Cryptocurrencies, in particular, offer a means of conducting international transactions without relying on traditional banking infrastructure or the US dollar. As digital currencies become more widely accepted and adopted, they could present a real alternative to the US dollar in international trade. So, what are the implications of de-dollarization for the global economy? Well, the most obvious impact is likely to be on the US dollar itself. As the world's reserve currency, the US dollar plays a central role in global trade and finance. A reduction in the demand for dollars could lead to a decline in the value of the currency and a rise in inflation. This, in turn, could impact US interest rates and the cost of borrowing for US businesses and consumers. However, de-dollarization is not necessarily a zero-sum game. While it may have negative implications for the United States, it could also have positive implications for other countries. By reducing their dependence on the US dollar, countries may be able to access capital markets more easily and improve their economic resilience. This, in turn, could contribute to a more stable and equitable global economic system. The rise of China is a particularly interesting case study when it comes to de-dollarization. As the world's second-largest economy, China has been actively promoting the use of its own currency, the yuan, in international trade. It has also been increasing its holdings of gold and diversifying its foreign exchange reserves to reduce its reliance on the US dollar. This has the potential to shift the balance of power in the global financial system and challenge US dominance in this area. However, it's important to note that de-dollarization is not necessarily a linear trend. There are many factors that could impact the pace and direction of this trend. For example, if the US were to implement policies that improve the stability of the dollar or address some of the concerns that are driving de-dollarization, this could slow down or even reverse the trend. So, what can investors do to navigate this complex and evolving landscape? In my view, the key is to focus on fundamental principles of investing. This means looking for companies and assets that are resilient and can weather economic and financial volatility. It also means diversifying across asset classes and regions, so that you are not overly exposed to any one currency or market.